Money's about flow, and exchange creates wealth. The more times dollars are exchanged because we serve others, solve problems, or deliver value, the more wealth is created. So dollars follow value. If you want to create more value, create a more compelling vision. You want to create more value, solve a bigger problem. You want to create more value, discover what your talents are instead of expecting someone else to hand you something.
Let me break this down into 3 ways to build actual wealth. The first one is to invest in yourself. So what does that mean? Rather than putting your money in everyone else's dreams, in a stock market you don't control, in the things that you don't understand, hoping for the best, let's think about the impact equation. Number 1, how can you reach more people with the value you create? Right? Dollars follow value. How do you create more value? How do you serve more people? How do you reach those people so you make that impact? The second thing is the current people you're already serving, how do you more deeply impact them? How do you deliver even more value? So invest in your knowledge, invest in your relationships so that you can expand your reach. You can expand the value you create, therefore making more money. Another example, you've got to create an automated structure so you could pay yourself first. So many people that budget do it because if they don't, all the money goes away through something called Parkinson's Law. That as you have an increase in income, expenses rise to meet or exceed that increase. And so I get why budgeting starts. And if you're a train wreck spending $2 for every dollar that comes in, listen to Dave Ramsey and Susie Orman and go out there and budget your way so that you're not going completely broke. But if you're making more than you actually need to live on, or you're making more and saving more, all you do is set up a separate account, just a checking, savings, or money market, and pay yourself first. If you have a payroll service, see if they'll send 2 checks, one to your personal account where you're spending money, and one to your wealth capture account where you're preserving money, right? Where you're protecting money, where you're building up a peace of mind fund so you have staying power. So just one financial incident doesn't wipe you out. So you don't have to go borrow on a credit card if you have a health challenge or a family issue. So you pay yourself first in a wealth capture account, just a savings account. It's not earning money. You could watch my cash flow banking video if you want to know what to do to get a 400 to 800% better return on that and some tax advantages, but it all begins with paying yourself first. So then you just live off whatever's left over. Whatever's left over, just don't borrow to consume. That's the main rule. Do not borrow to consume. Use the cash that's at hand and continue to look to create more value. Now, in order to do this, one of the best advantages is to go to wealthfactory.com/cashflow. There's a guide that gives you 3 specific tips to improve your cash flow so you can pay yourself first without having to budget or cut back. Now, the third thing, spend time with people that challenge you to think better. And think bigger, right? That are your cheerleaders, that are your advocates, that challenge you, that create accountability, that excite you, that inspire you. I love spending time with those people. I come away feeling better. I come away, they want to see me succeed. And when I spend time with people that are envious of my life or my wealth or the lifestyle that I have, and they want to tear me down, I don't want those people to destroy my confidence or my vision or to waste that time. Simply categorize 3 things. Who are your friends? Those people that cheer you on, that inspire you, that make you think bigger. Spend time with them and invite them to spend more time with you. Who are the people it's time to be friendly with? Friendly means they don't want to see you succeed, or they don't share your values, or they're a drain on you. Say no to their invitations in the nicest way and stop inviting them to things. And buddies might not inspire you. They might not have you think bigger, but they're fun to be around. Just spend less time with them, even though you can spend time with them, and spend more time with your friends.
Garrett, have you found a way to talk about the idea of the pie getting bigger rather than there being a fixed amount? Have you found language for this? Because I struggle with this when talking about it on capitalism.com.
Bro, I was just telling you I'm working on this play, and one of the very early scenes, I go, money and resources are not the same thing. Let me go back to that part of the play where I go, all right, I'm just going to read it because I'm coming into it. But yeah, I think this is it right here. We buy into the belief that resources are like pie. We got enough cherry pie for everyone in the room, except for Ryan takes 3 slices. That means the people over here aren't getting any pie. That's scarcity, a perspective I call the consumer condition, where people take more value than they create, and it's a trap. Because money and pie are definitely not the same thing. Even if there's a limited amount of money, they're putting it on screens as we speak, there's an unlimited number of times it can exchange hands. We use it to buy computers and clothes, food and shelter, entertainment like comedy and concerts. Basically, the more times money is exchanged, the more value is created. Unfortunately, in the consumer condition, people make irrational decisions, especially when it comes to their money. Irrational decisions reduce value and destroy exchange. In other words, they do stupid stuff. So it goes on, but there's a whole 3 pages on this concept. Yeah.
Well, so that's interesting. I never thought of that idea of when you consume pie, it's gone. It becomes poop. You know,
Right.
but when you consume money, and it keeps getting circulated. And the very fact of if all you did was have money in the bank loans against that. The loans that they pay interest on that loan. It's back in circulation as soon as it's there.
Right.
So there's really no way to hoard money. There's no way to consume money. It's just energy that goes back into the system. Well said.
Yeah. Think of it more like a river, like the Amazon River, than a dam. Like the Great Salt Lake. I live in Salt Lake. Is a dead lake that has a stench. Nobody lives around it. It's just dead. But the Amazon River has so much flow to that river that there's miles of fresh water in the ocean where it enters. And there's an abundance of life to the point where we'd be scared to probably get in that river because of how much flow there is. And so money's about flow, and exchange creates wealth. The more times dollars are exchanged because we serve others, solve problems, or deliver value, the more wealth is created. So dollars follow value. If you want to create more value, create a more compelling vision. You want to create more value, solve a bigger problem. You want to create more value, discover what your talents are instead of expecting someone else to hand you something.
See, hard work isn't enough to get you there. That's right. Most people will not get rich in 3 years because hard work with the wrong methodology, hard work with the wrong philosophy, or the wrong construct won't allow you to get ahead. Sacrifice is a lie that will rob you of enjoyment along the way and just disappoint in the end. From stage, I glance over and see this 6'7" giant man, tears rolling down his cheeks. After I finish speaking, he comes up and he starts to share how he was trying to sell his dental practice in Garland, Texas. He was exhausted and broke. He was even thinking about going to a 1-bedroom apartment, and as he says it, with a plastic box chair to sit on outside. If he could sell his practice and building, it could pay off all his debts. He was tired. Tired of being in debt, tired of always worrying. It's 2008 and everything is crashing. Brad was simply practicing dentistry. No rhyme, purpose, or reason behind it beyond survival. Drill, fill, and bill. He felt old. At the same time, he meets the love of his life, Carolyn. But when she comes along, he has to use her credit card to get an engagement ring. That's how broke he was. As a doctor, when he took Carolyn to meet with his accountant and went to the bathroom, the accountant advised her not to marry Brad until he had his $150,000 IRS debt handled. Carolyn created a list of things not to do if they were going to get married, like don't overspend. She said, Brad, it's time to cut back. You better start scrimping. It was all about budgeting. You know, guess what? Budgeting sucks. Brad felt conflicted, even kind of tortured, as it seemed like an unwinnable situation, love or freedom, and he just didn't know what to do. There was zero emphasis or focus on value for others. He was stuck. You can't dream when you're in survival. It's a selfish state of mind. It repels wealth. Reductionist thinking removes possibility. Forget getting rich in 3 years. What can be cut out, reduced, eliminated, or done less expensively doesn't take into consideration about how you can impact the people you serve the most by investing in yourself and bringing out the best there is to offer.
You just said that money is the tool really to sustain work and service to one another and new opportunities for us to pursue. And at Burning Man, it's another example of where there is no marketplace. There's no spending of money. And it works because it's 6 days long.
6 days, yes.
Right?
And there's tons of entitlement underneath that.
So much entitlement.
Yeah.
So
yeah.
there was somebody who came up to me and they found out that I run capitalism.com. And we had a very pleasant conversation, a very respectful conversation. But this person said, I think we can do better than capitalism. And I was like, oh, tell me more. And he said, well, just look around us. I mean, there's nothing being traded or bought and sold here, and it seems to get along just fine. And I said, you know, that's an interesting point. Let me ask you a question. What's the one thing that is provided for us as a socialized thing? What is the one thing that gets provided for by Burning Man? And he said, well, the toilets, of course. And I said, have you been in there lately? When was the last time you cleaned them? And he said, I now see your point. Right.
My wife
course.
goes with a sheepy so she can stand to pee with the sheepy device, so because they're so disgusting.
Yeah, so I mean, I like to say the purpose of money is to sustain service to one another. And when you're out in the wilderness, service is food or hunting on your behalf. When you're in the desert, it's a clean toilet or a glass of water, things that aren't available to you. Like,
Yes.
that is the purpose of capitalism. That's the purpose of money. And when you understand that, you can go into service-based mode, which is creation mode, which is where you get fabulously rich.
When you were playing the cash flow game, what came out of the game? Wasn't it your team or something?
Oh yeah, I realized that I had to build a team, and it couldn't just be financial planners or people that gave advice. I wanted people that actually lived it, done it, were wealthy, that spent time with wealthy people, and it took me about a decade to build that team, maybe a little bit longer.
I'm still building.
It was a
my
heavy,
team.
and but I got to tell you, it's paid off massively. I mean, that's one of my advantages that most people have is the type of team that I have and that I built, and that's part of what we do is we build teams for people that way.
Right, and this is the part what kills most people. Okay. In school, if you operate with a team, it's called cheating.
Exactly.
So tell them what your team consists of today, because it's the same thing I say. My team is called my Rich Dad Advisors, right?
Yeah.
What do you call your
I call mine the Accredited Network, and in joking, I call them the Financial Nerd Network because these are people that love this stuff.
Yeah.
I mean, even part of my team is having a guy that's good at understanding liability insurance. He can read he can tell you off the top of his head any contract, how it works, how to transfer risk. It's amazing.
I want you to hear that. On my team too, it's not the Rich Dad Advisor, but I have an insurance guy who reads all the insurance contracts.
Yep. And so he'll say, hey, did you know if we structure this with anyway, not going into content, but with an umbrella, then you're going to save this money and you're going to have $10 million more coverage. I'm going, genius, but that's what he looks for. Then other people I have on my team is like an estate planning and corporate structuring attorney. Right. So my asset protection trust, but he's also someone who's independently wealthy, has done a huge amount of real estate.
He practices what
he's
he
very
preaches.
well connected. He has billionaire clients. So I was like, look, I might be, when I start with him, I was one of his smaller clients, but I referred so many good people to him that he brought me into the inner circle and has been great to me.
Who else is on your team?
So on my team, I do have a registered investment advisor that helps me research and analyze deals, and he's also kind of my no guy. Why wouldn't I do this investment? You sniff out what's wrong with it and how we protect it. Then I also have a cash flow specialist that his job is just to look and analyze cash flow and make sure I look great to the banks. So when I go to a bank, I look good because my cash flow's good, collateral's right, credit's there.
So once again, these are big steps, but it's a change of the spirit, the being in here. Because, when I talk about, you should have a team, what stops most people from having a team is in school, you were taught that you had to be the smartest guy.
Yeah.
Are you the smartest guy on your team?
No.
I'm not the smartest guy on my team.
If I were, I'd be in trouble, right? Because you always want a room of people that help you grow.
The most stupid people are people who think they're smart. And I've been that person. I know all the answers. I meet these guys who are PhDs, MBAs, accountants, lawyers. They think they're the smartest guy, and they don't ask for help. And I was always a dumb shit in school, so I always ask the smart kids about stuff. So when it comes to investing, I look for the smartest guys that practice what they preach. So they're called Rich Dad Advisors.
People are the only real or true assets. So much of the game is won when the team is picked. One of the greatest teams you can ever have is a great tax and legal team. Why? Because most people are tipping the government. I mean, if you want to check something out, go to wealthfactory.com/tax. You can actually gather resources to support you in building that team. If you already have a large income, or you're working to get a large income, you're absolutely going to have a significant partner. That partner is called the government. Not always the most welcome partner. And so many people are paying more than they need simply because they don't have the right team. See, they're getting plenty. The government's taking property taxes and excise taxes like gas tax, there's sales taxes, just to name a few. When we look at the income tax, and there's so many ways that people can pay less in that, they just don't know because they don't have the right team. It can make a massive difference in your bottom line. For example, if you don't know about the Augusta rule, which is a way that you can write off your home 14 days a year, or if you don't know about D-pad credits, and it's something you go back and look at to find out if you've overpaid on intellectual property that you might have created, or if you don't know how to differentiate your income by choosing the right corporation and avoid self-employment tax, or if you've never heard about 199A, those are just a few things where I'm assured you're overpaying tax and now you're in the know. So that just reminds me of a quote from Pixar, right? So here's the deal. If you have a good idea and a mediocre team, they're going to screw it up. If you give a mediocre idea to a brilliant team, they're either going to fix it or throw it away and come up with something better. So Pixar works to hire the best people and then give them difficult challenges. You don't have to go it alone. Utilize the knowledge and expertise of others so you can go further. See, I believe you can't shrink your way to wealth, and ultimately, the problems we face in the world can be solved with the people and resources we already have, if they only knew about the value equation. Let me break this down into 3 simple parts. The first one is recover cash. There are 5 levers to becoming economically independent. That's to recover cash, that's to engineer wealth, that's to accelerate investment income, that's to scale revenue, and then make it count. We'll get more into what those 5 things are, but that methodology and framework helps. To recover cash being the first of those things, it's about the 4 I's. Finding if you've overpaid the IRS, maximizing your deductions, or taking on reclassification so you pay less tax on the dollars you earn. The second of the 4 I's is interest. These are the 3 R's. This is about restructuring loans. This is about reallocating resources if you have underperforming assets that can pay off higher interest rate loans, or it's about renegotiating to better interest rates. So restructure, reallocation, and renegotiation is on the second I of interest. The third I is investments. It's about turning them into cash flow. It's about protecting the downside, and most importantly, it's about removing unnecessary fees that don't add to performance. And the fourth I is insurance. It's about eliminating inefficiency or duplicate costs by making sure you have the right design. So that's the first of the 5 levers. The second lever is to engineer wealth. Engineering wealth is about knowing your monthly expenses and creating cash flow from your assets to cover those basic expenses. Now, the first way you can do that is in the third lever. It's to accelerate investment income. Where do you already have assets that you could turn into cash flow? Turn any accumulation assets into producing monthly cash flow, because the game is about cash flow first, cash flow second, and cash flow third. Now, how do you scale your revenue? This is about increasing your earnings by adding more value, making a greater impact, and being more strategic with your time. That's the fourth lever. So the first is recover cash. The second is to engineer wealth, to figure out what your monthly number is and create assets to cover those basic expenses. The third is to accelerate investment income, which is make everything you have turn into cash flow and recurring revenue to cover your basic expenses. Then scaling your revenue. That's investing back in yourself. That's growing your business. That's about the things that you can eliminate from your life that don't add enough value, so you can do more of the things that add the most value, therefore creating a bigger impact, therefore making more money. And then the fifth lever is to make it count. See, you are your greatest asset, not a stock or a bond or a piece of real estate. So what are you doing to relax, rejuvenate, and have some recreation so that when you show back up to do something, you're the best version of who you are? And it's about determining what success means to you, so you can learn to say no to things that aren't right for you and discern opportunities from distractions. Distractions lead us in the wrong direction, but a lot of people enthusiastically run that way. It comes down to the impact equation. This is about how many people can you reach, number one, and number two, how deeply can you impact those people, which is absolutely critical if you want to get rich in 3 years. The more people you can reach, the more money you're going to be able to make. So if we combine the impact equation of reach and depth with the value equation, it's going to unlock your potential by recognizing the best ways you can serve others. It looks like this. Our mental capital times our relationship capital determines our financial capital. So 3 years or less comes down to your mental capital. What are your ideas? What knowledge do you have? What wisdom, strategies, and insights? Where do you have something unique that can offer massive value to the world? See, those that say it isn't what you know, it's who you know. Well, if you don't know anything, nobody wants to hang out with you. It's one of the most precious forms of capital is your mental capital. Have you got a way to tap into that and to bring that to people? But the one where the most potential exists, the most underutilized, untapped resource is relationship capital. People are the only true assets. You are your greatest asset, not that stock, bond, or piece of real estate. So relationship capital comes in the form of networks, organizations, customers, friends, family, and the bridge between your mental capital and relationship capital is business. And the currency is value creation. So if you have a money problem, it's never really a money problem, that's only a symptom. Let me be clear, there are plenty of problems out there in the world that people throw money at and it doesn't really help. It's really a mental capital issue or a relationship capital issue. So if you have the money to solve a problem, I wouldn't say it's really a problem. If you have a financial issue, it's either about the wrong information or lack of knowledge or the wrong relationships. You're only one idea or one relationship away from the next level of prosperity. So how do you develop, expose, and create more mental capital? How do you deliver more value, serve more people, and really solve the bigger problems? If you have a clear path to do that, You can get rich in 3 years or less if you don't have major deterrents and obstacles like massive consumer debt.
First thing we have to understand is in the next decade, in the next 10 years in the United States alone, 50% of the wealth will transfer hands because 418,000 businesses on average per year will be sold that are private businesses. That's we're talking about almost 5 million businesses in the next 10 years are going to exchange hands. Well, there's going to be people now that have that cash. There's going to be people that have to buy those. The second thing is the stock market has been overly propped up and overly valued without consideration for technological advance that will start to decimate it, and hasn't been taken into consideration a number of eroding factors. And the reality is 84% of the gains in the stock market are got by 10% of the investors, which are mostly hedge fund managers that are actually trading short and long at different times. So when they say the market did 6% in a year, it might be 3% for the average investor just setting money aside, and inflation is going to decimate that 3%. Now we have to worry about deflation first and then inflation next. But if we just sit on money, it's going to be worth so much less. And there's more money in the economy, which will go back into the hands of people who are buying businesses, buying real estate, or doing intellectual property. Everybody else that's just handing money over or setting on it and saving it without intention for it will find out it will be worth less, and that they will be in a more dangerous situation because the things that they want to buy that actually matter from an investment standpoint will be further out of reach. So it is a critical 3 to 5 years that people start taking responsibility with their finances and do something about it. Otherwise, the middle class is going to become lower middle class in the next 5 years, and the upper class is going to become really wealthy if they're thinking about investment and leverage and acquisition instead of savings.
Businesses are absolutely a huge piece of this. And I'm not talking about businesses that are public businesses. I'm talking about private businesses. I endorse the book Buy Then Build by Walker Divo. In it, he highlights something called acquisition entrepreneurship. Acquisition entrepreneurs, as he says, start by buying an existing business instead of starting one from scratch. So many of the ones that are started from scratch that are kind of the Silicon Valley, tech ones, a lot of those make no money. They raise money, they burn through it, and they fail. Well, if we look at acquisition entrepreneurship, it stacks the odds in your favor. See, if you begin by buying a business and then take an entrepreneurial approach to building more value, this allows you to improve cash flow or get cash flow from day one. The combination of an existing small business's profitability and sustainable infrastructure with new innovation and drive by an entrepreneur is a magical recipe. So if you're an entrepreneur, this could be a great thing, because if you go out there in the stock market, how much are you paying for that? If we look at the profit of a major corporation that's in a mutual fund, for every dollar you have, it might cost 10 times more for that company than a private company. Meaning you can get a private company for 2 or 3 times multiple, or you might be seeing a 30 times in the public market. So there's this awesome opportunity here. See, the main benefit of acquisition entrepreneurship is that existing companies are already established with customers, brand awareness, employees, and most importantly, revenue and profits. All the things that a startup doesn't actually have. So instead of having to go out there and raise money for months and maybe often years, while also trying to build sales from scratch with a new product, the acquisition entrepreneur acquires a profitable infrastructure from which to begin. Existing businesses provide established markets, so they first don't have to worry whether they're too early or whether another company with more funding will beat them to market share. And in some cases, they don't have to worry about creating a market from scratch, right? Simply by buying a company, typically one greater than 1 million in revenue, you can remove so much of the risk that's inherent to entrepreneurship. Tim Carden, who's been on many of the YouTube videos with me, his brother Ben Carden, they've both done this. They've both gone out there and bought existing businesses and seen extraordinary success. This is also much better than putting your money in the stock market, like I mentioned, without knowing what's happening in a boardroom there and who the employees are. And with so many of the S&P 500 giants, they just move really slowly. That really limits growth. But most importantly, most of those stocks provide no cash flow or very limited cash flow. It's all appreciation potential. See, that multiple, as I mentioned, on a small business can be so much less, a fraction of what a large publicly traded company is. So there's so much opportunity inside of small companies that operate on legacy-based systems that have never upgraded to lean business models, meaning they've got old systems with tons of waste, and with the new insight, maybe there's ways to plug the leaks to eliminate that inefficiency, and you don't have to go develop something from scratch And maybe it's even like my friend Mike Geary that just is really good with online marketing, and he could get a business and immediately make it profitable from day one with his existing businesses because it's complementary. So I can hear you. You might be saying, I can never do this because I'm not rich. First, let me say that in my experience, very few entrepreneurs raising capital to launch any startup is actually rich. So I'm not sure the comparison of all that's too valid. That said, although brokers typically want to see a few $100,000 in available cash, it's the nature of buying an existing business that makes it much easier to gain access to capital. See, banks offer loans to buyers for up to 90% of the purchase price using the assets of the business as collateral. So according to Walker, the financing in these deals is typically done in one fell swoop, with you bringing a down payment or some type of equity infusion and the bank providing the balance. In addition, raising money from a bank means that you get to own 100% of the company yourself. You're not giving up equity. You don't have to have partners. And see, owning a business that generates recurring revenue is key. Recurring revenue can create economic independence. Recurring revenue can provide cash flow now versus waiting for 30 years for a retirement plan. So some questions that Walker would have you ask is, can this operate without my daily involvement? Do you know the metrics that matter and how to manage them? Can you create consistent cash flow with that business? Is the business something you can sell? Or is it just another job? I mean, it might be a self-employment opportunity, and maybe that's okay for you. But if you already have a business, can you acquire a business that you know how to monetize better than its current owners? Is there something complementary out there already? So, look, starting a business, that's a lot of effort. And it might take a long time before you get to cash flow. But what if you can already take a cash flowing asset and merely improve upon it and find ways that there's less reliance on you because there was already infrastructure? This is less risky if it's something that relies on your skill versus a startup that requires funding to release a technology that requires a lot of infrastructure. So that's the first asset. Existing small private businesses that you can get for a lot better price than major corporations.
I look at the bigger opportunity in the small business sector, because if we look at if we just look at the multiple for a major company, like if we're buying the stock at this price, what does that mean this company's worth? A lot of times it's 20 times what its actual assets are. Mm-hmm. I can't think of a small business that people are paying that for. If we look at 96% of small businesses do less than $1 million in revenue. So less than $1 million in revenue doesn't get big multiples. It would be shockingly rare. A lot of times you're buying for 1 to 3 times of EBITDA, which for those that don't know EBITDA, it's earnings before interest, taxes, and appreciation. It's just a way to calculate after certain expenses what the company is worth. So we can buy that at a deep discount, and there's actually more room for growth in a lot of those things, because a lot of business owners, as you know, neglect their cash flow, don't focus on their money. They're doing it all through hard work and effort without systems and structures. And so there's a massive opportunity to gain in the small business market, is way more than the big businesses, way more than the stocks.
Yeah, so let's go there, because I think it can be easy for the average person to see this as really bad news, but there's a lot of really good news in all of this too. Like when you mentioned that there are going to be a lot of big businesses replaced by up and coming businesses, and sometimes that can sound a little bit scary. But if we look at the last 20 years, where was Amazon 15, 20 years ago? Where was Google 15, 20 years ago? Where was Apple 15, 20 years ago? These were emerging companies at the time. These were companies that were just a blip on the radar, and now they're trillion-dollar companies. I don't know about you, but when I was a kid, $1 trillion was like saying a kabillion, billion dollar. Like it was a number that didn't exist.
Exactly.
Right. And now you have multiple companies that are worth $1 trillion. Where was Facebook 10 years ago? I don't even know if it was public 10 years ago. And so those who were looking at those companies are now fabulously rich because they were looking at where the world was going, right, rather than where we are and where we have been. I work with my business is capitalism.com. I help people start businesses, specifically physical product businesses, because that's where I've seen people get the most traction in hitting their first million in a year or so. Mm-hmm. There was just a case study that came out. It wasn't out of our community, but there's this company called Laird Super Creamers. Are you familiar with this company?
Super creamers? I know.
Yeah, so they're a powdered coffee creamer company, okay, right? And like it's big, and it's actually big in our little circle in like the paleo health community, right? So there's.
I'm an amateur barista. I don't do powders. I just
very good.
Beginning, so that's
very good.
That's
so this company does about $19 million in top line revenue. They're not profitable. Okay, so they're like they're growing aggressively. 19 million is nothing to sneeze at, but it's not like they're Facebook, right? They just went public and they currently have a valuation of $425 million, Garrett. Now, that's ridiculous. That's absurd. And it makes no sense. And I don't care, because it just shows how valued good emerging companies are, which is why I think it's the best time ever to take control of your finances by becoming an entrepreneur. Even little things that you start can become massively legacy changing for you and your family. And there's case studies like RX Bar, which was started in some guy's basement and sold for $600 million. There's Mirror, which was just a company started by a husband and his wife, and they were bought by Lululemon for $500 million in 2 years. There's Native Deodorant, which was started by one dude for $500. He started with $500. He sold to Procter & Gamble 2 years later for $100 million. There's a bunch of these case studies. And so there's plenty of good news happening while the structure of everything is fractured.
One of the other good news, you mentioned low interest rates, is for a down payment on a home, you can acquire a business. And with the interest rates the way they are today, the majority of those that you buy can cash flow from day one. Now, you have to get knowledge about it. You have to know what you're doing with it. You have to gain a skill set. But look, if people can go through school and learn math and science, they can learn business. Business is in some ways easier. In other ways, there's people and emotions involved, which makes it complicated. But, you've done it over and over, Ryan. So, you've got a formula. You understand how it works. And I just think that that's the news. The news is we've been trained, taught, and educated to wait for 30 years, hoping compound interest will save us. 95% of the time, people are not financially independent at age 65. So compound interest isn't the miracle it's purported to be. What is the miracle is cash flow and having entrepreneurship, because entrepreneurship comes with a lot of tax advantages and a lot of influence that you can do to have some degree of control over the outcome versus just hoping that it all works out. And so I think that it's a time for entrepreneurs to rise, because we have so many businesses coming onto the market, and there's so many things that can still be created or invented or dialed in. And Ryan, dude, when we were little babies, you and I were little babies, think about how much it took for someone to start a business versus now. The tools and infrastructure that exist that are near free or very inexpensive to help you to do something like that. I had someone that's a client that 2 years ago started a business on Amazon, struggling, does a call with my team. They're exiting for $3.5 million. Dude, they weren't even, I was just like, wow. And then they're like, hey, do you want one of these things for free? Thanks for all your help. And I was like, dude, it's crazy. Cause it's just amazing how short of a turnaround that was. And it was a mom that just was now, okay, my kids are out of the house. What am I going to do? And start a business. And within 3 years from the time it was started is selling it for $3.5 million. I mean, that's pretty phenomenal.
Real estate is an asset that can be good for some and bad for others, just like buying a business. See, it all depends on you. Risk is in the investor, not the investment. So all these assets are a lot more active versus fully passive. A lot of people just want to hand their money over and hope that it works out. That passive type of investing has seen such a massive failure rate because people don't know whether it's working or not. People are just trusting and hoping, but they're not sure if it's really the right thing to do. You can make these investments more passive over time. Without your input or responsibility, it's rare to find something that works from day one with no involvement. Real estate is to be treated like a business. To increase your odds of winning and avoiding mistakes, I'm going to take you through some of the keys from the book, The 5-Day Weekend, that I co-authored. Obviously, this video isn't an exclusive treatise on real estate investing, but Nick Halleck has done a ton of it. I've done a ton of it. And so here's what we came up with in the book. My goal here is to give you enough of the foundation so you can move forward with confidence if real estate's your choice. You'll need to learn what works for you. But here's what you'll want to know. Number one, focus on cash flow. If you have cash flow from day one, you're going to lower your risk and you can have that profitability. Second, the profit is in the purchase. When real estate is done right, you make money not when you sell, but actually when you buy. 3, look for multi-unit properties. So it's one financing deal, but you're getting multiple properties. And then if there's one vacancy, you have other properties that are producing cash flow. Number 4, get your financing in place before you buy. So meet with the bankers and the planners and understand the loans and maybe even get pre-approval. Number 5, know your market and your numbers. So before you buy a rental property, know the market you're buying in. Collect solid data. This might mean that you pass a lot of things up, but know what your parameters are and be educated before you invest. Number 6, don't get impatient and or emotional. You got to manage your excitement. That might be bringing other people to the team and having other people that might be, okay, I don't think this is the right time to move forward, even though you might have rose-colored glasses. So I want you to be carefully analyzing things and be logical. Number 7, buy in the right location. Location is an absolute key to profit. Study market trends, learn where the deals and demands are. Number 8, find properties where you can build sweat equity, right? So these are things like the older properties instead of new properties, where you can increase their value through upgrades that you put into them. Number 9, be smart about your renovations. What's worth the money and what's not worth the money. See, I want you to keep your budget expenses to 15% of purchase price. 15% of what you purchase it for could be the expenses that you can add. So find a pattern that works for you. Add value to rent out the properties faster, manage these properties wisely, screen the tenants, create systems for receiving the rent, have an emergency fund because things do break down, and make sure you have enough cash on hand to handle repairs. So I've given you a bit of a list here, but the key is I want you to hold on to your cash because if you tie too much up in property, equity isn't always accessible. So be careful and don't over leverage. Put maybe, make sure you're buying at 15% below the normal market value. Put 20% down to build in a buffer should the market crash, and understand market volatility and exit strategies. Things change quickly, so be on top of the trends and be prepared for the worst. So much of what people spend their time enjoying is intellectual property. I mean, think about TV shows and movies, watching comedians, to the content here on YouTube. So where do you personally have expertise? Can you improve the industry that you're in? Can you educate people on a product or process that solves a problem or improves someone's life? So I can also get recurring revenue through books that I write or subscriptions to memberships. Like if you went and looked at wealthfactory.com/Garrett Club, this is one of those memberships. There's an investment every single month, but people get me every month where I'm doing a Zoom call, I'm answering questions, I'm tackling a topic, I'm giving some of the newest things that I'm creating, I'm giving them a lot more depth than I might be able to in a 10 or 20 minute YouTube video. We give them these golden tickets where they can redeem certain, things like a financial trend summit that we did, telling people how to navigate a tough economy, which we're facing right now. We've got things like if someone's launching a business, a program that we call Scale, or if someone wants to become economically independent, a program called Curriculum for Wealth. And so they can redeem these with these golden tickets, and there's a concierge that kind of helps them out. I just did 19 calls the other day with people in that program to really discover and figure out what challenges that they're facing so that we can add even more value. And then we actually print a report every quarter of things that they can implement. So if you want to see intellectual property, you can go to wealthfactory.com/Garrett Club and take a look at it. I actually created a playbook for those in that club to take an idea to market without requiring borrowing of funds or risking all their money. It's my win then play playbook. I actually got a big compliment from my wife the other day. She says, "This is really good." I'm like, yeah, maybe I know what I'm doing, right? In it, we've got the cycle of creation. And in that cycle of creation, it outlines the process to take an idea to a concept to a framework that you can now delegate to eventually a product, service, or experience in the marketplace, but profit up front. So if you want to do this in 3 years, there's criteria that first you have to meet. Number 1, if you want to get rich in 3 years, you can't have loans beyond car loans or mortgages. If you have consumer-based debt that's eating away at your cash flow, that's feeling like a weight on your back and that's occupying your mind, 3 years is going to be highly unlikely. The second thing is you can have loans if they're tied to assets that produce cash flow. So yes, it's okay to have loans if it means you acquired a business or the right piece of real estate, and that's creating more economic independence and cash flow today. Third, you have to have upside potential where you work or own a business. So upside potential is great where if you work somewhere, you can participate in the upside, but you don't have the risks of the downside. Now, if you own a business, you can obviously scale or grow that by adding more value, reaching more people, or creating more consistent income on an ongoing basis. Now, you might even have a side hustle that can bring in extra money. It's known that 70% of Americans do right now. As simple as having Airbnb on their own home, to using the Turo app on their car so they could rent it out, to being a driver for Lyft or Uber. There's so many things that can be done. Those are just the really basic ones. So another piece is you have to have at least one catalyst in your life. A catalyst is an amplifier relationship that believes in you, connects you to people and opportunity, that makes sure that they know who you are, maybe even more so than you do, and see that potential in you, and they want to let the rest of the world know that. So it's easier if you have 2 or 3 catalysts or amplifier relationships. In order to find time for them, remove the toxic relationships in your life. So part of getting rich in 3 years is also you have to forgive yourself for past mistakes, and you have to face any pain that has caused you to lose confidence, or that you don't love yourself, or that you just don't feel that level of self-esteem. This does not require that you have lots of money to invest already.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.